Welcome back. We're going to continue on with our first example on group accounting. In the last video, we had a look at preparing the consolidated statement of financial position and consolidating the assets and liabilities of Company P and Company S. Remember, we're treating them as a group. Now, if you remember from the group structure, we did identify that Company P does have control of Company S, and as such, a group is formed with an NCI, a non-controlling interest of 25%. Now, we did step 1, the group structure, and we did step 2, preparing the consolidated SFP and add parent and subsidiaries' assets and liabilities on a line-by-line basis. So we did that, and that's where we got up to in this example. Now we're going to do step 3. Your core consolidation workings. And what you must remember is that these workings are always in the same order. Okay. They will always be in the same order. Okay? So they have to go net assets, goodwill, NCI, group reserves. It always has to be that order. Particularly the net assets first, because that's really the basis for your remainder of workings. So, our core workings then, this would be on a separate piece of paper away from the consolidated statement of financial position that you prepared in the previous video. So, we're going to start off then with our first working, and that's going to be the net assets list. Now, you always do the net assets list for the sub only, the subsidiary only. Now, do you remember when we did the accounting equation? We said net assets must equal capital, in this case equity. Well, that still applies here. Net assets, assets minus liabilities, equal equity. What we're trying to find out by doing a list of assets minus liabilities for the subsidiary is to work out what we acquired. What did that cost of investment actually buy us? In other words, what net assets did we get? Now, in order to do the net assets list, we take equity as indicative of net assets, assets minus liabilities. Because there's many lines of assets and liabilities, it's quite difficult and quite time-consuming to list them. So we use equity as net assets. So net assets equals equity. What we're trying to find is the value of what we acquired. What did $450,000 buy us in physical assets and liabilities in the subsidiary? Now, we have 2 columns for this. At acquisition, if you remember for this example, it was 2 years ago, and at CSFP, so at the consolidated statement of financial position date. And that was the 31st of December 2011, 2 years later. Now, again, we're going to express these in thousands because that's what the question does, and we use the same. And we go and have a look at the equity, the net assets of the subsidiary. So we can see then that under the equity section, we haven't ticked off any of the subsidiaries' equity accounts yet. Well, that's because we're going to use it in this working, the net assets list. We're going to take 200 share capital and 400 retained earnings. Okay? They are the only 2 equity accounts that we've been given, and they are the net assets of the subsidiary. So, share capital and retained earnings. So So we put in the narrative or the name of those equity accounts. If there was share premium, a revaluation reserve, they would all get included as well. But in this case, we only had 2 equity accounts. Now, we've been given 200 for share capital and 400 for retained earnings. Now, which column do you think those figures would go in? The column that represents the figures 2 years ago, or the column that represents the figures now? Well, they are from the financial statements dated December 2011. So, we're going to pop them in this column, just copied from the equity section of Company S's Statement of Financial Position. Now, what we have to do is establish what net assets were there when we paid $450,000 to acquire the subsidiary. Well, share capital will always be the same at acquisition as it is now. There will never be any new shares issued in the subsidiary after we acquired our 75%. Because if they did issue shares and we didn't buy them, the percentage holding that we have would go down. And that is way beyond this syllabus. Okay? So share capital or share premium, if you're given it, will always be equal. It will always be the same at acquisition and at year end as well. Retained earnings, though, your accumulated profits won't be equal. Now, the Company S would have had 2 years' worth of income statements post-acquisition, so after we acquired them, in which they accumulated profits, which would have increased retained earnings. So, we need to establish what the growth is in the subsidiary post-acquisition. Post-acquisition, after acquisition. Now, we were told about the retained earnings of the subsidiary at acquisition in note 1 of the question. So can you see in note 1 it says, at the date of acquisition, S retained earnings were $100,000. So 2 years ago, their retained earnings were $100,000. And that would have been the net assets that we would have bought at that date. That's what we paid $450,000 for. So, $100,000 from note 1. Can you see then that the subsidiary has grown post-acquisition? You see there? It's grown. Okay? And it's grown by $300,000. So as a result of the parent acquiring 75% of the subsidiary and thus having control, we would have helped the subsidiary contribute to their profits over those 2 years. So surely then the parent would want their share of that growth in the subsidiary that they had a hand in helping them generate. Because remember, we tell them what to do with their assets and liabilities, and you use your assets to generate revenue, which then drops down into profit. So, working out our net assets then, now we've listed them out. $300,000 of net assets were there at acquisition, and $600,000 worth of net assets were there at the year end, 2 years later. At the date we paid $450,000 to the subsidiary, what we receive in return is a proportion of their net assets, which were $300,000. Can you see that we paid more than their net assets at the date of acquisition 2 years ago? Well, that is going to create some goodwill. If we pay a premium on top of the value of the net assets, well, there must be some excellence or reputation, a good thing that we are buying into as well. So, the net assets, what is there, the things that are there in the sub at acquisition, is always used for goodwill. Because we're going to pay that to the price we pay. If we pay over the fair value of the net assets, and when I say fair value, I mean market value. Yeah, today's value. Well, the true value of their net assets at acquisition was $300. We paid $450. There will be some form of goodwill arising if we're paying a premium. Now, the difference between these two columns is known as the growth. the growth in the subsidiary post-acquisition, which could equally be a decline as well. Usually it's a growth. Can we see then that the difference between the 300 and the 600 is that $300 growth post-acquisition? Okay, so the subsidiary has grown in value after we acquired 75% of them. Now, as such, the parent company would want their share of that growth because we would have had a hand in helping them generate that growth in profits. So the growth post-acquisition will go to two other workings. Group retained earnings and also the valuation of the non-controlling interest. Now remember, we only own 75% of the subsidiary shares. So any profits that the subsidiary makes post-acquisition, well, legally I'm only entitled to 75% of that. And that's going to group retained earnings. The NCI would expect the other 25% because they're the minority holding. They would still expect a return on their investment through post-acquisition profits. So the net assets list is really the basis for three other workings we need to do. Goodwill, group retained earnings, sometimes referred to as group reserves, and NCI. So you must do the net assets list first to establish what assets and liabilities the subsidiary holds at acquisition, but also what was there 2 years later in order to get the growth post-acquisition. Okay? That end column we don't need to use for anything. It's just the difference between the two columns that gets posted. So what you must remember is what those net assets figures are used for. Goodwill, group reserves, group retained earnings, and NCI. Now we've done that, we can apply them to our next working, goodwill. Okay, goodwill. Now, goodwill, remember, is the excellence or reputation in the subsidiary business that you've acquired. If you've paid a price greater than their assets and liabilities on their statement of financial position, you've bought some goodwill. The reputation, the customers, their staff, all of which wouldn't be shown on their statement of financial position, but it does contribute to the good reputation of the subsidiary company. So, this working will always look the same. We start off with the fair value. So remember, fair value is today's market value of consideration given. So what is the fair value of the price we paid to acquire 75% of the subsidiary? Well, we acquired 75% and it cost us $450,000 in cash. Notice that's the same figure under non-current assets. And we're going to use that figure now and tick it off. Fair value of consideration given is sometimes known as cost of investment. Okay? But it's a value today and what we paid, what we gave in order for 75% of the shares in the sub. We were told that was $450,000. We always start off with that figure. Now, what we then have to do at that point is find 100% of the value of the subsidiary at the date we acquired the subsidiary 2 years ago. Because all of the goodwill in the subsidiary is not owned by the parent. It's not owned by me. It's also owned by the non-controlling interest. Yeah, they would have a share of that goodwill as well. So we need to find the value of 100% of the subsidiary to compare it to 100% of their things, their assets and liabilities. So at this point, we always add the fair value of the non-controlling interest. And that will always be at acquisition, because goodwill will only arise upon the acquisition of the sub 2 years ago. 25%. Now, we were told that the fair value, the market value of the subsidiary's 25% shareholding, the non-controlling interest shareholding, we were told that in note 2. The fair value, the market value of the non-controlling interest, 25% of the sub at acquisition, was $150,000. Okay? So usually that would be the number of shares that the non-controlling interest has multiplied by the share price of the subsidiary at the date we acquire the subsidiary. Yeah? So the market price. You will always be given this figure, though, in the exam. You'll never be asked to calculate it. So, 150 is the value of the other 25% of the shares. Which means then the fair value of the business, the subsidiary at acquisition, so 100% of the business is $600,000. That's the value of the entire shareholding of the subsidiary at the date we acquire them. Okay? Now what we've got to do is compare that to the physical book value, the carrying value of all the things in the subsidiary, the assets and the liabilities. We remember assets minus liabilities are net assets. So less net assets at acquisition. And we got that from our net assets list. The 300,000 is the value of the things in the subsidiary at acquisition. And we're going to use that for goodwill. So I'm going to tick that off there. Because it's at this point that I'm going to minus 300 from the fair value of the business. Now, the difference between the value of the business today and the value of the physical things in the business, the assets and liabilities, would give you the goodwill, the value of the people, your customers, your loyalty of your customers, your reputation, your staff, the knowledge of your staff. That is all goodwill. And that would be an intangible asset. Goodwill would be the other 300,000. So it looks like the people in the business are just as valuable as the things in the subsidiary. Okay? So the net assets represents the things, the physical items in the business. But the value of the business is not just based on the things, it's also based on the people, the excellence and the reputation. And that's what goodwill is. And that arises on consolidation when you pay for a subsidiary and you pay more than their net assets. So, this is our first figure that we're going to use in our consolidated statement of financial position. And if I can ask that you go back to your statement of financial position that we did in the previous session, goodwill is an asset to the group of 300,000. And that would be an example of an intangible asset. Okay, so there we have it. Our first figure for the consolidated statement of comprehensive income now complete. We're still looking for two others though, retained earnings and non-controlling interest. The next working we're going to do is for non-controlling interest. So, next working after goodwill will always be NCI, non-controlling interest. We've got to reflect the fact that, yes, we control 100% of the subsidiary, but we only own 75%. We have to put a value to the other 25% of the subsidiary because the group is not just owned by the parent, the subsidiary would own a small proportion of the subsidiary, which is part of the group. So, There'll only ever be 2 lines to this in your exam. We start off with the fair value of NCI at acquisition. So we start off by valuing the 25% holding that we don't own in the subsidiary by using the market value of those shares that 25% of the subsidiary has, the NCI. We've already used this figure. Do you remember up here in goodwill? Fair value of NCI at acquisition, 150. This represents the value of the subsidiary 2 years ago. Okay, 2 years ago. Now, we want today's value 2 years later because we're preparing a consolidated statement of financial position 2 years later. Now, has the subsidiary grown or lost value? Well, we said the subsidiary had grown in value by 300,000. And remember, we said that the NCI will want that share of their growth. It's going to show a growth in their investment. So, we are going to take 25% the NCI share of the subsidiary's post-acquisition growth, which we said was 300 from the net assets list. So, 25% of post-acquisition growth in the subsidiary will increase the value of their investment post-acquisition. So we're going to take 25% of 300, and that is, of course, going to give us 75. So the value of the NCI 2 years after acquisition is the initial market value plus the growth in the investment represented by the post-acquisition growth in retained earnings. So, NCI value at the consolidated statement of financial position date, so CSFP, will be 225. And NCI will only be those 2 values. What is the value at the date we acquired the sub? And how much are we going to give to them post-acquisition to grow their investment? Okay, we've got to give them their share of that. So that represents the value of their share in the subsidiary, which is part of the group. Their share is equity, so it's 25% of the subsidiary would be non-controlling interest. And we're going to pop in 225 into the end column to represent 25% of the sub that the group doesn't own, or the parent doesn't own. The parent owns all of itself plus 75% of the subsidiary. And that's really what we're trying to reflect in our final working, group retained earnings. So, our final working then will be for group retained earnings, or group reserves if you like. Now, do you remember I said that the parent owns all of itself plus 75% of the subsidiary? Well, we've already given the NCI their 25% of the subsidiary, but now we need to give ourselves the other 75% of the subsidiary, and we need to give ourselves our retained profits as the parent. Now, if you go back to the question, notice we've dealt everything in the notes 1 and 2, and we've dealt with every item on the statement of financial position, with the exception of the parent's retained earnings of 650. Well, that is the final figure that we're going to use and start off with in group retained earnings. You always start off with the parent's retained earnings because they own all of themselves. Okay, that is their retained earnings. Remember, we're preparing the group accounts for the owners of the parent shareholders. What do the parent shareholders want? Well, they want their retained earnings plus 75% of the subsidiary that has been bought with their money. So, we're then going to add to that 75%, the group share of the post-acquisition growth in S, in the subsidiary. So 75% of the growth, which we worked out in the net assets list as 300, is now going to be taken to group retained earnings. So 75% of 300 will give us the other 225, which is going to increase the group's accumulated profits or retained earnings. And that's it. So again, this will only be 2 lines for now. So, retained earnings at CSFP at the 31st of December 2011 would be 875. Notice we're not taking 75% of the subsidiary's accumulated profits at the year end. We're only taking 75% of the growth, because what was there as retained earnings at acquisition of 100, we had no hand in helping the subsidiary accumulate that. We only helped the subsidiary accumulate profits post-acquisition. And that's why we only take 75% of the growth and not 75% of the total retained earnings of 400. Because of that 400, 100 of that was already there before we acquired them, and therefore we wouldn't have been entitled to a share of that. So, 875 is going into our consolidated statement of financial position, and that's our final figure. So now what we want to do then is just balance off the statement of financial position. Now we've done step 3, our core workings. So, total PP&E for the group would be 1,500. Plus goodwill of 300 is going to give 1,800 group non-current assets. Inventory for the group was 550. Receivables were 350. And bank was 500. Group current assets would be 1,400 to give group total assets in the end column 3,200. So that's the top half of the group SFP done. Looking at equity, the owners of the parent's equity is 1,375. That represents there the shareholders in the parent's capital plus what they are entitled to, which is all of the parent's retained earnings, plus 75% of the subsidiary. So this represents all of the ownership in the parent plus 75% in the sub. And then if we add the other 25% in the sub, which is the NCI, group equity would be 1,600. Okay, so equity for the group. 75% of the sub in parent, and then 25% in the sub for the NCI. So we're just splitting out the ownership between the parent shareholders and the shareholders of the NCI in the subsidiary. Loan notes were 150 for the group, under control, and then 1,450 payables for the group, and that's going to give us 3,200. Our group statement of financial position balances. Okay? And if we follow those principles of consolidation and do those core workings in the order specified, you will always be successful in group accounting. Okay? And again, it's like the same with all the other things in F3. The more you practice in it, the better it will become. The only extra thing we need to learn is various adjustments that we need to do to the groups upon consolidation. Okay, but the basic structure of this will always be the same.